From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
So we're 30 minutes into the US trading day. It is Thursday the 17th. What do you need to know? What are the top stories that we're going to be following for you at this hour? Well, the Kremlin downgrading expectations on peace talks progress. President Biden is going to speak to China's Xi Jinping tomorrow. What comes out of that, we'll discuss. The Bank of England follows the Fed and hikes by 25 basis points. But the focus is on the risk of growth slowing down rather than the risk of rising reflation. Almost a complete 180 of where we were with the Fed. And the chaos in the nickel market continues. The LME's trading system hit by further technical glitches, despite the exchange widening its trading limits. We'll talk more about that as we work our way through the hour. From London, I'm Guy Johnson. In today, Gina Martin-Adams. She's in New York. Alix Steel is off. Welcome back, everybody, to Bloomberg Markets. Gina, do these markets make sense to you right now? Does the reaction to the Fed make sense to you right now? Equities in the United States up again today.
Yeah, well, listen, I think we had priced in a lot of the Fed action as of even the decline that we saw in the U.S. markets in January. So the equity market was well prepared for what the Fed said yesterday. We've literally priced in more than anticipated before any tightening cycle we've seen since the 1970s. So it's been a very rough start to equities, and I think you have to keep that in mind. Also, the narrative really shifted over the last few weeks on account of the Ukraine and Russia war. Equities were starting to get very concerned about inflation. So this is a bit of a relief that the Fed is indeed going to stick to the plan, is indeed going to do what they can to remove this extraordinary policy support that has existed now for 2 years.
Very different responses from the bond market and the equity market. Different signals, very different signals in so many ways. A headline crossing the Bloomberg, U.S. mortgage rates rising above 4%. For the first time since, I need to just double check this one to make sure I get the date right, 2019. If Alix Steel was here right now, she'd be crowing about the amazing rate that she managed to lock in. As I say, though, bond traders trying to figure out exactly what they should make of what we got yesterday from Jay Powell and the FOMC. Certainly, I think there is a disbelief maybe that the Fed can deliver the kind of tightening that is being priced in by the dots. The gap between 5s and 10s inverting for the first time since March 2020. Let's kick this around. Let's kick the different kind of reaction we're getting from the equity market and the bond market around. We've got Gina here. We've also got Ira Jersey, US rate strategist for Bloomberg Intelligence. Ira, let's talk about this. Equity market signaling one thing, bonds signaling another. You've got a flatter curve, though we're getting a little bit of a gyration now in the middle of the curve. Talk to me about what the bond market is seeing in what the Fed is doing. Does it believe that actually growth will end up being a bigger problem, and as a result of which, maybe a recession is coming more quickly than anticipated, and as a result, we're getting this flat inverting curve?
Yeah, the yield curve is going to invert. When you look at the forward markets and what the market's priced for a year from now, almost the entire yield curve is being priced to invert, and that it historically has been a signal that we get a recession. I think the question for risk asset markets, so things like corporate credit spreads and the like, is will it be a shallow recession that is kind of relatively, I don't want to say benign, right? Because there are real world effects on individuals and families and businesses when you have a recession. But is it a slow, shallow recession, or does it wind up being more of a very significant crash? And I think part of that will depend on whether or not the Federal Reserve delivers on what it's said yesterday in its statement. And if it does hike 7 times this year and another 3 times next year, then there's a strong possibility that you could have a relatively deep recession, just because you'll wind up with the economy slowing too quickly and people getting really nervous about making new investments. But if they go maybe a little bit slower, then maybe not so much. And one way or the other, Jay Powell yesterday said that there's not going to be a recession in the next 12 months. I think that's true. But, what he didn't say is, there's probably going to be one in the next 18 months, which I think is a little bit of a nuance that the chair avoided yesterday.
Ira, could you talk to us a little bit about the reliability of those forward curves in predicting recession? I think the equity market is counting on somewhat unreliable signals from the bond market and really sticking to the near-term signals from the yield curve as opposed to those forward curves suggesting that maybe there's an out. Maybe the forward curves are wrong and ultimately will adjust in the other direction. Talk to us about that history.
Yeah, so the only way that that happens is if the Federal Reserve doesn't deliver the hikes that they've said they're going to. Part of this is a little bit mechanical, but in order to get long-term interest rates much higher, you need to have one of two things occur, or both. One is you need to continue to have inflation expectations more or less where they are. Looking at my Bloomberg terminal right now, around 2.84% for 10-year Treasury yields. But the market still has very negative real yields, and the way to get real yields higher is twofold. And one, the Fed will deliver on, and that's quantitative tightening. So reducing the size of its balance sheet. Typically, at least the two times that it's done it in the last decade, is you've seen real yields move significantly higher. That's number one. Number two is you have to not avoid a recession, right? So real yields tend to go down during a recession because you wind up having growth rates that are pretty low, if not negative, and so investors kind of think that you're going to have real yields that are going to be negative because the Fed's going to ease monetary policy and the like. So in order for those forward curves to reverse, I think you have to have just a more dovish Fed than you have right now.
Gina, I'm going to kind of throw that back at you. Mm-hmm. The equity market lives much more in the here and now than the bond market does. What predictive power do you think the equity market has, given especially the fact that we now have maybe more of a focus on long duration assets, particularly when it comes to the tech sector?
Right. Well, I think the equity market is pretty good at actually predicting recession and usually falls by up to 20% in advance of recession. Over the year in advance of recession, we've already fallen by 10, which I think is somewhat reflective of this outlook for much tighter policy. We're not pricing in any sort of deterioration in growth anytime soon. And when Ira tells me, we may have a recession in 2024, the equity market is going to default to, who cares? 2024 is 2 years from now. We're not going to price in a recession 2 years from now until we start to see earnings growth deteriorate. So I think what the equity market has done is really focused on the rates aspect. Valuations have come in line with the idea that rate policy is certainly tightening. The Fed is moving into a new regime, if you will, of significantly more hawkish conditions. But we're not seeing in the equity market any deterioration in growth. I mean, the earnings numbers are pretty good indicators of what to expect in terms of the growth input for equities. And earnings estimates are still very strong, indeed abnormally strong for this point in the cycle. So we've got to see significant downward pressure emerge on those earnings estimates before the equity market starts to get more nervous about recession, frankly.
Ira, does anybody have a clue right now really what is going on? We basically, what we're dancing around here is the idea of which market is best at predicting what is going to happen. And I'm not sure anybody's got a particularly good clue what is happening right now. Oil markets all over the place. You've got geopolitical tensions. Really unclear what happens in China next. We talked to Nathan Sheets yesterday, the global chief economist over at Citi. This is what he had to say on the predictive power of economists right now.
We're looking at energy shocks. We're looking at a massive increase in just global uncertainty. The guidance that our models can give us are very, very limited. And I think that we're going more right now just by gut instinct.
Ira, do you think the bond market's operating on gut instinct right now?
I don't think so. I think that the bond market right now is reacting to the monetary policy situation as well as inflation, right? The reason why you have 10-year Treasury yields above 2% is because you have such high inflation, and inflation expectations, according to the bond market, like I mentioned before, are still looking for, over the next decade, inflation averaging nearing 3%. And that would be a significant sea change from the last 2 decades when you had inflation hovering, around 2% plus or minus a little bit. So if inflation expectations stay stay where they are, then you're likely to have 10-year Treasury yields somewhere 2% or north of 2%. And then the question becomes, is if the Fed delivers on its monetary policy, I don't want to call them promises, but its current expectation for where monetary policy could go and how significant the inflation threat is to them, then you will have interest rates be somewhat higher than they have been over the last decade since the global financial crisis. So I think what's going on in the bond market is very rational, but I think what the bond market is trying to figure out is how to live within some of this uncertainty that you mentioned, Guy. Right? Like will there be a slowdown in China and Europe, for example, that might significantly hurt the global economic outlook, and will the Fed be able to go that 7 times that they've said, and the market is priced for that right now. So that can change significantly over the next couple of weeks.
I find it just fascinating to compare and contrast what's happening with the Fed and the Bank of England, both hiking 25 basis points in the last 24 hours. The Fed focusing on strong growth. We need to get a handle on inflation. The Bank of England turning tail completely, focusing on the growth aspect, worrying about the income squeeze. Inflation's going to rise, but we're going to focus on growth. Ira, we're going to leave it there. We could carry on for ages. Ira Jersey of Bloomberg Intelligence, thank you very much indeed. Up next, we're going to talk about the Kremlin putting a damper on reports of major progress in peace talks with Ukraine. We're going to have the latest developments. That's next. This is Bloomberg.
They're using their superior knowledge of the terrain and their own geography, as well as their nimble behavior in terms of using these systems they're getting quite effectively. And they have essentially stalled the Russian advance.
That's, of course, Pentagon Press Secretary John Kirby speaking in an exclusive interview with Bloomberg's Maria Tadeo a little earlier today. Meanwhile, a Kremlin spokesman saying that a report of major progress in talks with Ukraine was, quote, wrong. We're joined now by Bloomberg's Washington correspondent Anne-Marie Jourdain to talk further about this. Anne-Marie, Maria just pinging through a note on the terminal, talking about the idea that actually what we've also got going on here, and we should also pay attention to, are talks that are happening between Ukraine and Turkey. Erdogan has a fairly good line into the Kremlin as well, and the idea here is that maybe we could be setting up a conversation between Zelensky and Putin. Given your reporting, how likely is that, do you think?
Well, both governments have said that a meeting could be on the table. President Zelensky has said that very publicly, but Sergei Lavrov, Russia's foreign minister, has said in the past that a meeting could happen, but there would need to be justification for that, an endpoint, a means to that meeting. And right now, when you have the Kremlin saying that Financial Times report that there was progress in these meetings, calling that false, Ukrainians yesterday I spoke to said to me that they don't see any significant progress, and they point to the fact that those bombs are not abating on Ukrainian infrastructure, on cities filled with civilians. So I find it challenging to see that a meeting could happen soon unless the Kremlin was very serious about potentially a ceasefire at this moment. We should also note that President Putin has talked pretty much disparagingly against President Zelensky. And if he was to sit down with him, that would almost legitimize him to the Russian people. I'm not sure the Kremlin is ready to do that just yet.
Anne-Marie, you're right down there in D.C. Talk to us a little bit about the sentiment out of Washington this morning after that video address from Zelensky to Congress. Do you sense there is even more momentum behind providing support to Ukraine, maybe sending more folks in to help in negotiations?
Well, right now what you have following that incredibly emotional, impassioned speech from President Zelensky is, of course, a lot of pressure on the administration to act. But President Biden yesterday announced more arms to Ukraine. That included drones. And these drones seem to be a very welcome outreach from the administration to Ukraine. They could be very helpful. You had John Kirby talking to Maria about all the military and economic support they have given to Ukraine. But what we do have, of course, is the president going to Europe next week, and also a very critical phone call tomorrow between President Biden and Xi Jinping, potentially maybe trying to get China on board to influence President Putin.
Thanks for the update, AMH in DC, thank you. Bloomberg's Anne-Marie Hordern. This is Bloomberg. So the Fed hiked by 25 basis points last night, the first time it's done so since 2018. Chair Powell signaling there will be 6 more coming this year. The bond market, it's unconvinced. It thinks the Fed is going to struggle given the growth impetus is going to fade, that the Fed will be able to deliver on those hikes. Karen Old-Tambor, Bridgewater Associates co-CIO for Sustainability, joins us now. Karen, you still think the Fed's behind the curve. The bond market thinks it's going to struggle. Give us your view.
The bond market is basically pricing in a relatively moderate increase in interest rates when you put in perspective just how far inflation has risen. And if you break down the bond market pricing between the real interest rates and the expected inflation, which you can do, of course, with the curve on inflation-linked bonds, you can see that while inflation is expected to be high for the next year or so, maybe 2, it's expected to pretty quickly come down afterwards. That's why longer end rates are relatively low. And so more or less, the bond market and the stock market together are pricing, kind of a magical scenario where the Fed tightens not that much. It doesn't kill the expansion because you still have equity prices doing what they're doing, and inflation magically comes down. And if you look at history, that looks pretty unlikely. And it really, to me, echoes of what happened in 1973, when inflation pressures were already the highest had been in a long time. Then you get a big geopolitical shock that's exogenous. And it's just not pleasant to be in the Fed's shoes and tighten into an exogenous supply shock in commodities that has to do with geopolitical events, doesn't have to do with domestic demand. It's just easy to fall behind the curve in that situation when you're reasonably worried about the stagflationary impacts that could happen. But you saw what happened in the 70s. It's very easy to fall behind the curve, and it's a very bad situation for investors.
Karen, I think the equity market anyway, at least my perception of the equity market, is that they're sort of leaning on the employment situation and the steady growth as indicated by employment figures, which is certainly a key characteristic difference between now and 1973, when unemployment peaked or troughed all the way back in 69, when it was on its way up persistently over a period of years into that 73 correction. Can you talk to us a little bit about your outlook for growth and how that's playing into your thesis that this is another 73? Are there key differences that we should be mindful of? And do you see something more nefarious coming for the employment markets?
No, I agree with you. I think growth is incredibly strong and self-sustaining. And really, inflation and how difficult it is to contain inflation is the main parallel. You have a very strong cyclical expansion that at this point is very self-sustaining. It started out getting stimulation from both the Fed and fiscal. But once you get that going and, more income creates more spending, it tends to be incredibly self-sustaining. And that's why you see inflationary pressures everywhere. It's very broad. It's not in, one area where there's a particular supply constraint. You see it pretty much in every sector, everywhere you look. And that's why it's going to be so hard to cut it off and probably require a lot more tightening than currently being priced.
Karen, if this is 73, where do I want to be? Where do I not want to be?
Well, the thing you learn is that, nominal bonds are the worst possible thing you can hold, because as inflation keeps picking up, as the Fed needs to tighten into that, the bond market tends to lag that move. That's probably the last thing that you want to hold. Probably the easiest switch to make if you need to hold bonds is to just switch them into inflation-linked bonds, because then you will just get paid whatever CPI prints. And you've seen over the last, a few months already what it's been like to be an inflation-linked bond investor relative to a nominal bond investor. You're getting paid those prints as they're coming in very high. You get paid headline inflation, whatever it prints. In addition to that, most people don't have a lot of commodity exposure. And from my perspective, that is one of the best possible ways to diversify your portfolio, to have a very direct exposure to those supply shocks remaining, to having demand continue to outstrip supply, and to having a squeeze across all the things that we use.
Karen, given your role as co-CIO of sustainability there at Bridgewater, I think we'd be remiss not to leverage your insights on what's going on with the energy materials space, as well as generally sustainable supply chains around the world. Your team's done this great work recently talking about the necessity of governments getting engaged and spending on a transition to cleaner sources of energy. How do you see what's going on in the world right now as either promoting that thesis and really pushing governments in that direction, or potentially even detracting that idea and really pushing it to the back burner as we contend with this crisis?
Well, I think that there's a strong political consensus, especially in Europe, that climate change needs to be curbed and we need to transition our energy infrastructure and the world's energy base away from where it is today to one that has significantly lower emissions. That said, there are two basic ways to do it, and they make sense. One, you could take all the quote unquote bad things like oil, coal, things that create carbon emissions, and raise their prices, whether that's through carbon pricing, through stopping the supply. The other thing you can do is subsidize the good things, make the renewables cheaper, directly spend fiscal resources on expanding renewable supply. And what was happening ahead of this crisis is a lot of the efforts to curb climate change, where governments were most serious about it, like Europe, were very focused on raising the prices. So carbon pricing, taking coal offline, that sort of thing. Now you get this big shock. And you're basically having energy prices rise in a way that's not that conducive to tackling climate change, because obviously the squeeze on something like natural gas, less bad for the environment, is much worse than the squeeze on, say, coal, which is significantly worse. And in my view, the political will to keep tackling climate change through raising energy prices is going to fall. It was already very low. It was impossible to think about carbon pricing in the US. Political will to do it into this environment, it's just not going to make sense to use these inflationary tools of raising energy prices being the way that you try to address climate change. The path to deal with that, and you're seeing Europe already eye at this and start kind of hinting this direction, is to go make renewables cheaper, go spend, go have big fiscal programs and double, triple your efforts to go get more renewables online faster.
Carol, in 30 seconds, how has the war changed the ESG outlook? What is ESG? Any thoughts on that?
I think that the response you're getting in the private sector, from private sector capital to the war, in terms of the moral outrage from Russia's behavior translating to real action, is way far beyond what anyone had imagined the private sector could do. I think that if we were talking about this before the invasion, we wouldn't even be mentioning things like, is Russia reliant on payments from Visa? What if McDonald's closed all its stores? The response has been swift, it's been rapid, and it's happening at asset owners, it's happening at consumers, it's happening at employees. And to me, this is a new bar of what ESG can be, what it means to have a private sector response. And it's only a matter of time before people say, wait, if you can do this on Russia, why not on climate?
Karen, we've got to leave it there. Thanks for your time. This is Bloomberg. So we're an hour into U.S. trading. What's going on? Let's find out. Abigail Doolittle tracking all the action. Over to you.
Well, guys, certainly an interesting session. And we're looking at the first three-day rally for the S&P 500 and other major indexes that we've had since early February. This, of course, into and out of the Fed. The S&P 500 right now up 0.2%, reversing a pre-market loss. So investors taking a little bit more of a constructive view, perhaps thinking that the Fed won't be able to stick with their plan, or that somehow that there was some sort of a bit of a dovish tilt. That's also showing up in bond yields. That 10-year yield coming in 4 basis points after an extraordinary backup in recent weeks. You can see the one outlier here is the China Tech Index, that Golden Dragon Index. Extraordinary yesterday, up 33%, the best day, not surprisingly, ever. I cannot remember a legitimate index, or frankly, stock. I mean, stock maybe so, but index ever climbing 33%. And that, of course, a lot of different factors in China, including the fact that Beijing was talking up the stock market to some degree, or liquidity, plus the idea that lockdowns aren't going to be quite as bad. That's helping out oil. We have oil popping back higher, Brent crude back above $105 per barrel, and the idea that the world's second largest economy is not going to be offline. As for what could be next for yields, yesterday I was showing a very simple chart saying that we could see yields come back in. This is another way to look at it. This is what I call an ugly range. More technically, it's a broadening formation. It tends to be a bearish formation, but forget about the outcome of it. It looks as though we could see yields go back toward the bottom, a defined set right around 175. That also would be in line with momentum going back to the bottom. So we may see a little bit of a easing of the backup in yields that we've had. If that's true, homeowners and buyers, actually I should say home buyers really, and sellers for that matter, will be happy because we do have that 30-year mortgage back above 4% for the first time going back to 2019. That could psychologically be difficult, but Guy, I wanted to show this long-term chart. That's nothing. So if above 475, that would be above, let's call it the 10-year average. But look back 20 years, we're closer to 8%. So still very, very low. But every little bit here could be a big psychological difference to folks in the housing market here in the U.S.
I'm a child of the 70s. I remember rates being even higher than that, or certainly my parents complaining about them. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle. Let's turn our attention to what is happening in China. The coronavirus lockdown in the city of Shenzhen means more problems for global supply chains. Now, let's talk about what Shenzhen is. It's more than just a tech hub. It's also home to one of the world's busiest ports, as you can see here. Now, most of these ports are in China. These are measured by millions of 20-foot equivalent units, i.e. containers. Shanghai at the top, Singapore, Ningbo. Then we get to Shenzhen before we get to Guangzhou. These are huge ports. Closing down the ports obviously having a major impact in terms of global shipping, also having a major impact in terms of the tech sector. The Shenzhen lockdown forcing Apple supplier Foxconn to temporarily quit making iPhones. The company has now resumed partial operations. In fact, we're seeing some of these restrictions being rolled back. But nevertheless, the impact is going to be significant. We learned certainly during the pandemic the impact that these port shutdowns can have in terms of supply chains. So let's talk about the potential impact in detail and what it's going to mean in the United States. We're joined now by the Executive Director of the Port of Los Angeles, Gene Soroka, joining us now in New York. Gene, we've seen this movie before. We've seen these shutdowns happen. What impact do you think it's going to have this time?
Well, good afternoon in London, Guy. We're watching this very closely, keeping up with our colleagues overseas, but we're also watching the impacts around closures of these factories. That's going to be key. As we've witnessed in the past, the Pearl River Delta area of container terminals and ports allows us to move that cargo around. So if the port and complex in and around Shenzhen, specifically Yantian Container Terminal, shuts down, we can move to the west side over to Chiwan or up the coast to Nansha, Guangzhou, Dongguan, etc. But it's the factory segment that we're going to be watching. The pause will be minimal compared to what we've seen in the past, but then when they come back to work, they're going to need to catch up on orders. So we will probably see a lull in 4 weeks' time based on these closures, and then a pretty quick rebound when workers come back. That gives us some time to work down the cargo that we have here now and be prepared.
Gene, have you seen any impact of the Russia-Ukraine crisis yet? And if you do see an impact, how do you expect that to play out?
No impact on freight. Port of Los Angeles only has less than 0.2% of its cargo originating or destined to Russia. But what we are watching are the flow of agricultural commodities and where the world markets are going to have to pick up to help the European Union. Second, we're watching very closely on the distribution of energy products as the world is right now. And equally as important to us, the cyber threatscape. We've got the nation's first and still only cybersecurity operations center. It's now stopping 40 million intrusion attempts a month, and that's double what it was before COVID-19.
Incredible.
Wow. That's an incredible number. Let's talk about what we're seeing in the U.S. economy right now, Gene. You are obviously the gateway for that economy in so many ways. The Fed was talking yesterday about the strength that it still sees in the economy, the demand that it still sees in the economy. What are you seeing? Any sign of things slowing down, or is this an economy that is still roaring ahead?
It still is moving very fast, Guy. January and February were all-time record months at the Port of Los Angeles for container flow in and outbound. We're also seeing that the second quarter, as projected, will be major retailers and home improvement stores building their inventories back up. We're at the lowest inventory sales ratio we've been in the country for over a decade, and that needs to pick up from a safety stock perspective. So while this lull may be coming because of what we see in South China, and that's about a third of all of our cargo, we're still going to see a very strong Q2 coming off a good first 2 months to start the year.
I'd like to move a little bit to policy, because I know we've had a new initiative from the Biden administration supporting the supply chain data flow. Talk to us about what that means in terms of what will we get out of this new initiative?
Yeah, it's about interoperability and having these major players in the supply chain share their information. Okay. In Los Angeles, we've got the country's only port community information sharing system through the Port Optimizer. We're decades behind other trading nations like Germany, Belgium, Singapore with their systems. The idea is from service providers to cargo owners, importers, and exporters, get your data into a multi-dimensional platform so we can start seeing around corners and over hills, preparing for spikes or declines in business much better than we're doing today. As a country, we're working off of spreadsheets and conference calls. We need to improve that data share, and that's exactly what Flow is going to do.
And if I could follow up on that really quickly, how does that then pair with what you were talking about with cyber attacks? What will be the security measures put around such a comprehensive system of information to ensure that cyber attacks don't impact that data?
Yeah, Gina, that's a necessity, and that's why we've gone from the Cybersecurity Operations Center to a Cyber Resilience Center, which for the first time brings the private sector in under the FBI's Neighborhood Cyberhood Watch program. If someone gets impacted, they can share that data. We can synthesize it across the port community. We've got to now scale that nationwide.
Gene, in terms of the bottlenecks that you're experiencing right now, you and I have talked over the last 18 months, 2 years, as we've worked our way through the pandemic. It's been people, it's been trucks, it's been all kinds of things that have caused bottlenecks. Where are they right now?
The port's in much better shape, Guy. In fact, cargo velocity has increased so much that over the last 30 days, we've moved out 16% more cargo than we did in the fourth quarter on average. So that productivity to get goods into the domestic supply chain has improved tremendously. But we still have 55% of our truck gates that go unused every day. We've got to continue to encourage the cargo owners to pick up their goods when they come in, not use the port as a warehouse, but as a transit facility as it was designed. We've got latent capacity right now to catch this next wave of cargo.
Why do you have so much of that capacity open? What is the holdup? Why aren't the trucks picking up the goods at this point?
There are many reasons, Gina, operationally, process-wise, information sharing-wise. But what we've seen is a lot of the big retailers have ordered just in case, not just in time. So we've got to do a better job as a community segmenting that cargo. So if it's not needed in market right now, just move it to the side. So those critical goods, 20% of all our imports are manufacturing parts and components. We've got to get those to the factory floors. The devices for our hospitals and medical community and other time-sensitive products. If we can keep segmenting, we'll do a good job of moving cargo velocity through the port system.
Gene, what kind of inflation rate are you seeing right now? The Fed thinks it needs to stamp on inflation and stamp on it hard. What do you think? What are you seeing?
Well, there are two sides to this coin. Obviously, everyone is focused on inflation. We feel it at the grocery store, at the gas pumps. Even the cargo prices are still very high for the container level business. But with more than $1 trillion in American savings accounts, we still see retail sales pumping through. 0.3% growth in the month of February. On top of that, adjusted 4+% retail sales growth in the month of January. That's a really, really fast start to the year, and we don't see any let up just yet.
I'm sure, Gene, you keep a pretty close eye on the competitive dynamics between LA ports as well as the other ports around the United States. Any telling signals we can derive from the differences between what's happening in LA and, say, some of the East Coast ports or even more northern West ports in the U.S.?
Gina, we see bottlenecks throughout the supply chain, even at the ports on the East and Gulf Coast. We've got to find a way to improve the flow of those goods and bring back certainty to the import and export community. We've also got to connect that exporter back to their market. The exporter needs visibility on containers, truck and rail service, matching up with vessel services. We've got to smooth out these curves as quickly as we can. Information flow is a part of it, but even in the Southeast United States today, we have vessels off the coast waiting to dock and be worked. It's not simply a Southern California phenomenon anymore.
Gene, it's always great to catch up. We really appreciate you coming in to see us. Gene Soroka, Port of Los Angeles Executive Director, sir. Thank you very much indeed. A little headline coming through from the Chinese news agency Xinhua. President Xi to exchange views with Biden on topics of mutual concern. The focus of this conversation certainly I would expect to be firmly on what is happening in Ukraine right now. We don't know much detail about this call that is set to take place tomorrow between the leaders of China and the United States. When we get that, we will bring it to you. This could be one of those pivotal moments that we need to pay a great deal of attention to. What are we going to do next, though? Tesla puts a $1 billion bond issue on hold. It's the third issuer in the past week to push pause on a major bond sale. We're going to look at what's going on in the primary credit markets next. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta. You're looking at a live shot of the principal room. Coming up, Sherry Paul of Morgan Stanley Private Wealth. That's on Bloomberg Markets. The close at 3:30 p.m. here in New York. This is Bloomberg. Keeping you up to date with news from around the world, here is the first word. I'm Rishika Gupta. The expanded arsenal that the U.S. is sending to Ukraine includes 100 armed drones. Bloomberg's learned that the drones are tube-launched from the ground and plunge into their targets. It's called the Switchblade and is made by Aerovironment. President Biden has also promised thousands of anti-aircraft and anti-tank missiles. White House coronavirus coordinator Jeffrey Zients has plans to leave the Biden administration in April. He'll be replaced by public health expert Ashish Jha of Brown University. Zients spent much of his time securing the purchase and distribution of vaccines, as well as treatments, tests, and protective equipment. And Bloomberg's learned that Tesla has put a bond offering of more than $1 billion on hold. The bonds that were backed by leases on its electric vehicles, and the portions of the deal had already been sold to investors. But surging inflation and concern about the war in Ukraine have sent short-term rates higher. That's prompted issuers to put their plans on hold until markets have calmed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg Guy.
Rishika, thank you very much indeed. So Tesla, not the only company to put a bond sale on hold recently in the primary market. In the past week, the auto finance company, Omni, and Affirm did the same thing. Let's talk more about the credit markets and what is happening in the primary market in particular. Bloomberg's Sonali Basak joins us now. Sonali, Rishika just said that Tesla's putting its bond on hold until markets have calmed. Is there an expectation that the primary market is going to calm? I appreciate that it's pretty much stasis right now, but is there an expectation that things are going to calm down and we'll be able to have an easier pricing environment anytime soon?
And for what asset, right, Guy? You see what's happening with the ABS market. You had Tesla, you had Affirm, you had World Omni, like you had said. But if you look at the IG market, you do see you have some major bond issuances coming back. Just look at that $30 billion offering from AT&T and Discovery's combined media business just last week, GlaxoSmithKline. My sources are really saying right now, Guy, Gina, that there is some demand and some ability to get big U.S. IG deals done. Europe is in a really hard place right now, but then if you go down to anything a lot riskier, high yield, ABS, leveraged loans, that's when things get a lot tougher.
What trigger would they be looking for to come to market then? What is it that they're looking for in terms of volatility or rates or signals that would make them feel more comfortable?
Well, one thing that's interesting with rates is you have to wonder if a lot of this is happening to get ahead of the rate rises when it comes to those large bond deals that we had just mentioned. But when you look at also the volatility that's in the market, that's really still what's spooking people. It's not the absolute prices. They just want prices to be stable so that no issuer or investor is leaving money on the table here. If you look back and see what is happening to the indices themselves, I want you guys to take a look at what's happening to the Bloomberg high yield index here. It has fallen off quite a bit. And a lot of the private equity players, Guy, you and I have talked to KKR, for example, see that as such a great buying opportunity here. So for a lot of people, it's the perfect time to enter, but they just can't do it when things are whipsawing.
Well, okay, so what kind of trades would they be putting on?
Well, the steep drop-off you're seeing in the index there, the reason I want to pull it up also is because there's a lot of people who are thinking this is the perfect time to go short certain bonds, to go short certain markets, let alone treasuries. So that's one major trade we're seeing out there. We're seeing some of the people with a higher risk tolerance say that distress and that both in the sovereign area, by the way, that is sold off with kind of the rest of what's happening in EM, as well as what's seeing in corporates. The spreads are going to come back in at some point, point, but they're wide enough now to get into. But again, it is only for those with not the faint of heart, right? It is the people who are able to get in, but a lot of people here on the sidelines.
I know you've had a lot of conversations over the last week with investors in this space, as well as the issuers themselves. And it does seem to be more about volatility than anything else. How many people are starting to talk to you, though, about the broader impacts of Russia, Ukraine, and global risk and geopolitics, and maybe starting to say, okay, maybe the growth outlook isn't so good anymore? Yeah,
that's a huge part of things. There's a lot of credit investors in particular where stagflation is much more of a conversation than you're seeing for the equity investors, which are maybe not thinking about it as much, have a little bit more optimism. The credit investors are also worried about the margins and the eroding of the equity base here, because they're saying there's just a little less cushion there than there was before. So, you know, a lot of people are talking about the divergence there. Actually, they're a lot more connected than you would think. But on geopolitics, that's why I had mentioned Europe as well. The U.S. is still such a big safe haven here when people are really worried about that growth slowdown in Europe more than they are in the U.S. So they do see it coming here as well.
Right.
Sonali, nice reporting as ever. Thanks for bringing it to us. Sonali Basak, thank you very much indeed. Coming up, it was another day of chaos at the London Metal Exchange. Nickel markets are having problems reopening. I think that's the understatement. Details next. This is Bloomberg. So it continues. The London Metal Exchange Nickels market has been paralysed once again today by glitches. It comes after, of course, that week-long suspension. When do we get to a clearing price? When does this market start to function? For the daily instalment on this story, we turn once again to Bloomberg's Mark Burton. Mark, bring us the latest.
Hi. So it was another unexpectedly frenetic and chaotic start to the trading day in the nickel market, where we had a case where there was a new trading limit imposed at 8% of the prior day's closing price. But when brokers came to put orders in at that level this morning, they found that their orders were cancelled. And that led to a rapid effort to recalibrate those trading limits to allow the trades to be placed, which they were. And then inadvertently, the LME opened the market about 4 minutes earlier and allowed a number of trades to take place before suspending it again, and trading resumed in a slightly less chaotic fashion at 8:45. But it remains incredibly illiquid. So far today, two contracts have traded on the LME's electronic market. On the day before trading closed on Monday, trading volumes were about 25,000 lots. So the market is truly paralysed. As things stand, there are about $3.3 billion worth of orders in the system to sell nickel at the limit down price. But it's now a question, as you say, of just trying to find a clearing price. The expectation is that prices are going to need to keep opening lower each day until they calibrate more closely with prices that are traded on the Shanghai Futures Exchange, which has remained open throughout this whole saga in London. The precipitating cause in all of this, of course, was the sharp rally in prices and the huge margin calls that created for bearish investors, bearish traders, and one entity in particular, Tsingshan, as we've reported. That short position still needs to be covered. And so at some point, there is likely to be a very frenetic break in this paralysis that we're seeing in the London market. It's just a question of when. Currently, the London market is quoted at about $42,000, and equivalent prices in Shanghai are it's about 30,000. So we could have another few days yet of limit down trading before we.
Mark, the longer this goes on, you have to wonder if it doesn't spread to other metals or other assets traded on the exchange. Are you seeing any signs of spread, or is this really isolated to nickel so far?
Well, as we've seen, there's been a lot of commentary among hedge funds, among traders who are extremely frustrated with the way that the LME has handled this, and they're making the decision to pull their trades off the LME entirely. So there is some spillover already, and there's a question as to how bad that will become. And on the face of it, it looks like there could be some very significant contagion, as you say. And the timing could hardly be worse for the LME. You know, this has been a 2-year bull market in the metals markets and commodities more broadly. And prior to the closure, trading volumes were absolutely flying, having kind of rebounded from a fairly sort of languid period over the past couple of years.
Okay.
So to have pulling off is bad news.
Mark, great stuff as ever. Our daily updates on the LME. Mark Burton, thank you very much indeed. Coming up, Madeline Jones of Oak Tree Capital. This is Bloomberg.